Good morning, ladies and gentlemen, and welcome to the Q2 and H1 FY23 financial result discussion conference call of MTAR Technologies Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Irfan Raeen from Orient Capital. Thank you, and over to you, sir.
Thank you, Michelle. Good morning, everyone. Myself, Irfan Raeen from Orient Capital. We are an investor relation advisor to the company. I hope that all of you and your families are safe and healthy. On behalf of MTAR Technologies Limited, I extend a very warm welcome to all participants on Q2 and H1 FY23 financial results discussion call. Today on the call, we have Mr. Srinivas Reddy, sir, Managing Director and Promoter, Mr. Guneshwar Rao, sir, CFO, and Ms. Srilekha Jassi, Manager, Strategy and Operations. I hope everyone had an opportunity to go through our investor deck and press release that we have uploaded yesterday on exchanges and on company's website. I would like to give a short disclaimer before we start this call. This call may contain some of the forward-looking statements which are completely based upon our belief, opinion, and expectation as of today. These statements are not a guarantee of our future performance and involve unforeseen risks and uncertainties. With this, I hand over the call to Srinivas, sir. Over to you, sir. Thank you.
Thank you, Irfan. Hello and good morning, everyone. Thank you for taking the time to join us today. Today on the call, I'm joined by Mr. Guneshwar Rao, our Chief Financial Officer, and Ms. Srilekha Jassi, our Senior Manager in Strategy and Operations, and Orient Capital, our Investor Relation Partners. We have uploaded our updated investor deck, press release and results highlights on the stock exchanges and company website. I hope everybody had an opportunity to go through the same. I'm pleased to inform you all that H1 FY23 has been a record half year in the history of MTAR with highest ever revenue and PAT. The company has clocked a revenue of rupees 126.2 crores with an EBITDA of rupees 34.9 crores and a PAT of 24.7 crores. Further, I would like to give a brief overview on sectorial performance and outlook. The company continues to witness a significant growth in clean energy segment. We have also introduced a lot of new products in this segment, which is enabling the company to grow even at much higher levels. We have generated close to about 99 crores from clean energy, which includes fuel cells and other related sales that we have done in this segment. And also we have delivered a very high number of UMA units, about 1,034 this quarter, and also about 40 units of electrolyzers as well. Further, we are also working on the under the clean energy and hydro sectors and also in wind and waste to energy projects. We also received orders from new customers in this segment, and we're building the first articles for them, and we hopefully would turn out to be much higher volumes moving forward in the next financial year. As I mentioned earlier, we have received substantial orders this quarter, which is close to about 650 crores plus, which includes orders from nuclear segment, space, clean energy, all put together. The company continues to strengthen the clean energy vertical to power a safe future and is currently in discussion with a lot of new customers that are in hydro, fuel cells, and hydrogen storage systems. Our closing order book, as I mentioned, as of 30th September, has been to tune of 1,288 crores with an order inflow of 643.5 crores. And we are exceptionally pleased to receive the kind of orders that we're looking at from various segments, especially in the clean energy segment, because of our latest innovations that we have done recently. We are on track to achieve our given annual guidance of 55 to 60% growth in revenues with an EBITDA of 30% plus minus 100 basis points. And As I mentioned earlier, the second half is going to be much stronger than the first half, so the EBITDA levels, we would be able to catch up on that and achieve the guidance what we have given in the past. The company, as I mentioned, is consistently placing efforts to diversify its customer base, and as informed, we have added customers to the GE Hydro, also in the clean energy segment this quarter. We are also in discussion with several customers from not only in clean energy but other verticals as well. Our CFO, Mr. Guneshwar Rao, shall be discussing the financial performance for Q2 FY23, and I would like now to hand over to him to take this forward.
Everyone, and a warm welcome to our earnings call. I will take you through the financial and operational highlights, post which we will open the floor for questions and answers. It is very satisfactory quarter for both in terms of YOY and QOQ, and also our highest order book ever in the history of MTAR. So regarding the financials, revenue from operations stood at 126 crores in quarter 2 FY23 as against 91.3 crores in Q2 FY22, which translates to 38% increase in year on year. EBITDA reported at 34.9 crore in Q2 FY23 as compared to rupees 29.4 crore in Q2 FY22, which is 19% increase on year basis. Profit before tax stands at 33 crores in Q2 FY23 as against 27.1 crore in Q2 FY22, which is 22% increase on year basis. Profit after tax was rupees 24.7 crore in Q2 FY23 as against 19.1 crore in Q2 FY22, which is 30% increase on year basis. Our diluted EPS stands at 8.03 for Q2 FY23 as against 6.2 for Q2 FY22. Our net working capital as on 30th September is 263 days, which includes 93 days are due to work in progress. We have some long project times, lead time projects are there, which required to maintain inventory. So the work in progress is inherent in nature in our business. So we need to have this working capital so that we can. This is meant for future sales. We are also working on reducing net working capital days. Our target is 200 days by end of this financial year. And our ramp up in revenues is expected to reduce our fixed costs and thereby improving our margins as envisaged by us. As informed by our MD, we are looking to forward to increase our absolute profit and maintain EBITDA level around 30% plus or minus 100 bps. We are also strengthening our team and systems further to cater the highest growth we are witnessing from now onward. And with this, I open the floor for discussion.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Deepak Krishnan from Macquarie Group. Please go ahead.
Hi, sir. Thank you for the opportunity. Just probably one question from my end. Wanted to understand the gross margin variation that we saw this quarter versus previous quarters, and similarly on your other expenses, they seem to be flat Q on Q despite the substantial increase in revenue. So just wanted to kind of run through any special one-offs or any factors that have impacted gross margins and as well as aided other expenses.
Gunesh, you want to answer that?
Yeah, I can take this call. See, the gross margins due to the higher export revenue, the little bit gross margin variance is there, and also some of the domestic projects, so the quarterly numbers, will have a different
I'm sorry to interrupt, sir. Your voice is breaking. Can you please repeat your last line?
Yeah, this is regarding the gross margin. The highest export turnover, whatever we have witnessed in this quarter, which is resulted the gross margin, lower gross margin. And also some of the domestic projects where we have the gross margin is differ from project to project. And this resulted the lower gross margin, higher the material cost and all. So on an overall basis, by end of the year, we will maintain the gross margin, whatever we were on the average basis, we will maintain on the year-end basis. So the second question, can you come again, Deepak?
Yes, sir. I just wanted to understand the sharp improvement we have seen in lower other expenses this quarter. That is really aided our EBITDA margins. Anything that's more sustainable? Do we kind of see this trend continuing?
So as we know, the growth what we have envisaged 55 to 60% in terms of revenue growth, we are actually augmenting our manpower requirements for the future requirement. That has resulted the operating expenditure as operating expenditure. So there is no issue. By end of the year, we will maintain our margins as we said earlier. The higher revenue, the fixed cost percentage in terms of the revenue will be lower by end of this financial year.
Sure, sir. Thanks for the answer on that. And maybe just on the order inflow, like we see good order inflow in the clean energy sector. Obviously, you declared the Bloom order, but other than that, we also see additional 90 crores orders. So could you kind of highlight? Are these from new customers or are they from existing Bloom orders itself?
We have received orders from clean energy in the case of Bloom Energy to the maximum extent. We have also received orders from nuclear segment. And also we have received initial orders from GE Renewable, who is our new customer right now in the clean energy segment. It's a combination of all this and orders coming in from space as well. So majority of the orders have come in from fuel cell, and we expect a lot more orders coming in the fuel cell segment in this quarter and Q3 and Q4 as well, because we are introducing new products in the clean energy segment, so which we have got qualified recently. So we're expecting a lot more orders flowing in during the next 2 quarters as well.
Sure, sir. That's encouraging to hear. I'll just get back on the question queue. Thanks for answering my questions.
Thank you. We have the next question from the line of Sandeep Tulsian from JM Financial. Please go ahead.
Yeah, good morning. Firstly, very congratulations on the robust growth that we've delivered in the current quarter. So first question is pertaining on to your guidance, this 55 to 60% guidance that you have given, and the presentation mentions that you're expecting 300 crores of revenue in second half. So would you want to revise it to the upper end of this guidance or probably exceed the 60% growth in the current year that you can do in the revenue?
Sandeep, basically, we have given this guidance at the beginning of the year. We always like to under-promise and over-deliver. So we have been looking at that all the time. Obviously, the way the numbers are moving up and having a very strong second half of the year, obviously the revenues will be much higher. But I would still like to stick to this guidance, but definitely we would be doing much better than what we have guided everyone on this subject.
Understood. Fair enough. So just being conservative on that end. Secondly, on the order inflows, also we had guided around 850 odd crore order inflow, because that is what translates into your 1,000 crore of closing order book for the year end. But we have achieved that number in the first half itself. So where would you want to peg this order inflow guidance for the year? Because I'm sure there will be second tranche of Bloom Energy orders coming in fourth quarter, and also nuclear energy. Correct me if I'm wrong, but there is one more order which was pending where we were able to be booked. Has that already come in this quarter, or there is some portion which is still left? So what kind of an order inflows can we expect for balance part of the year? And if you can highlight some major orders that you're looking forward to.
So as of now, see the nuclear energy order has already come in, Sandeep. It's there in the order book already. We have received that in Q2. That's about 62 crores and all. As far as the further orders are concerned, yes, we are expecting a lot more orders coming in, but we'll not be able to quantify it right now. But since we have got qualified for new products in clean energy and also with other customers, we're expecting orders flowing in even during the third quarter and the fourth quarter of this financial year. So we'll have a very strong order book. As I said, closing order book being 1,000 crores, probably we might exceed that, but I would like to stick to that and let's see how it goes. But the way things are going and the kind of innovations we are doing, we expect a lot more orders flowing in at this point of time. So let's see how it goes moving forward.
Okay. So third question is pertaining to your nuclear segment. We have seen very weak execution in first half, just 8.5 crores of revenue. Our order book continues to be very strong. It was 160 crore at the year beginning. Now it's more than almost close to 220 crores. So where is the main bottleneck? Why is the execution slow? Is it the delivery timelines are such? How should we look at the annual growth numbers in this segment per se?
So as I said, Sandeep, the nuclear orders, a lot of work is being done, and we have these projects of cooling machine and all this work in progress going on right now. So some of these projects will get executed during the second half of the year, both in terms of coolant channel and FMED and all these new projects that we're working on for the last 1 year and plus. So we'll be able to catch up on those numbers in the second half of the year. So the cycle time for these projects would take that much time, and there are certain clearances to be given by the department, so it's happening the way it is. But second half we'll be able to catch up and improve the numbers of the nuclear segment.
Got it. Sir, next question is regarding your volumes for hot boxes. You had guided this year you should do somewhere around 4,000 boxes, next year about 7,000. If you can guide, is there any change to these numbers that you're expecting? And also Bloom Energy's recently commissioned a 2 gigawatt electrolyzer plant in US. So if you can give us some guidance, you said you did 40 units in this quarter. What can be the annual volume run rate this year and next year in electrolyzers as well?
See, electrolyzers, we are continuing to do batch production right now. And for next year, the initial orders, which they said they would release, is for 200 numbers. And probably that number would go up as and when the time passes by over the next 2 quarters. But we are right on track in terms of this 4,000 and 7,000 units. All that is right on track in terms of our execution level, which you must have seen in this quarter as well. And even in the next quarter, the numbers are much higher. So we are right on track in terms of executing these orders and the numbers what you had mentioned earlier.
Okay. And anything on the hydrogen boxes in terms of volumes that we can expect next year?
Yeah, see, ultimately the electrolyzers and hydrogen, that particular products would really do extremely well. They'll ramp up very high. In fact, probably we're looking at a little bit more time, but probably by next year the ramping up should happen in a big way. Probably by end of FY24 we will see a very huge ramp up happening in those verticals, which can be even bigger than the Yuma and the Kilaku verticals that we're looking at.
Got it. So one last bookkeeping question from my side. The other income has been coming in quite high, the 4 crores last quarter, 5.5 crores this quarter. If you can just, or Mr. Guneshwar Rao can just share the breakup of the other income will help.
I think the other income is mainly related to scrap and other than the operating related expenditure, these things. So it is negligible, but I will just come back to you. The reason for this other income is, just a minute. Just a minute. Also the forex gains which we received because of the higher dollar rate, where our receivables are very high. So that's why major the forex gain has come.
How much was that, sir, in second quarter and in first half? If you can share those numbers, please.
So these numbers is 1.9 crores in the first quarter, second quarter around 4.4 crores.
Got it. That's it from my side, sir. Thank you so much for taking this question.
Thank you. We have the next question from the line of Jitin Arora from Axis Mutual Fund. Please go ahead.
Hi, sir. This is Nitin here. Thanks for taking my question. Sir, the first question is on your new client, which you talked about, GE Renewable. Can you throw some light how big this can become? What are they ramping up? And eventually, it's the Yuma boxes only which you are supplying. If you can throw some light on this new client addition.
See, GE Renewable is basically on the hydro sector. So they've given us the initial order with the new customer for us for our Adipatla plant for about 5 crores. That's the starting point. But based on our commissioning of the machining facilities in Adipatla by end of this year, calendar year, obviously this is going to grow bigger and bigger. It's not only GE Renewable, we are working with Voice. We are working with Voice as well, Andrix as well. So a lot of these companies are approaching us to execute their projects. So we're hoping that this will become a much larger volume moving forward over the next 1 year, 2 years.
Okay, that was the previous one. I thought something would have added in the clean energy part. So
yeah, that's it.
I got it. In terms of scalability with respect to the new client in the, let's say, in the same SOFC, I understand Bloom is the only company which is doing that. The rest of other people are in a different technology. But and you said that if you have made this product, you can eventually do other products as well, which is made by Ballard, another one. So any update on that in terms of new client addition?
Yeah, we are actually working on that. See, so one thing, Nitin, we have to understand is that a lot of these companies, if you really analyze it, they have to come to the volume levels of Bloom for us to really address them. Yeah. I heard Plug Power is just started coming to India and setting up offices in India. That's what I heard. But all these companies ultimately need to start looking at outsourcing their requirements. We are talking to various customers as of now. But end of the day, the volume should be good enough for us to address that. In any technology, we need to work on it, but we have a great platform to address all this. But one significant thing is we are now going to work on the fuel storage systems. Like Fluence Energy from US has approached us, and we are in advanced discussions with them. That's going to be a very big boost to the numbers moving forward over the next 1 year or so. So we are adding on customers which would not only make sense to MTAR in the long run or in terms of revenue growth, but also in terms of profitability. So that's what we're looking at. So a lot of good customers are approaching us, and it's a matter of time over the next 1-2 years we'll have a lot more customer base in fuel cell and fuel storage systems as well.
Okay. Just one clarification on the gross margin. So quarter-on-quarter revenue, which actually led no other change in any other segment, it's just the clean energy, which is export, has increased. But that itself leading to a gross margin decline of 600 basis points. There is a commodity impact as well here, if you can clarify that.
So regarding the gross margin 600 basis, it is not purely on the export. There is export, definitely the raw material cost is higher, whereas fixed cost is lower. But there are other projects where we have a raw material versus value addition. There is a differences are there. Some cases maybe 50%, some cases 40% raw material, some cases maybe 50-55. It depends on the so many other, like we are doing lot of products, but on an average our gross margin is around 50%. By end of the year we will maintain around 50-52%.
All right. Thank you very much, sir. I'll come back in the queue.
Yes.
Thank you.
Thank you. We have the next question from the line of Dipesh Agarwal from UTI AMC. Please go ahead.
Good morning, sir. Sir, my first question. Yeah. So my first question is, in terms of inventory, what is the average inventory in terms of with respect to production schedule, raw material inventory you are stocking in with respect to production schedule on month basis?
See, so go ahead. No, normally in the case of clean energy,
Your voice is
we
breaking.
maintain around.
Sorry to interrupt.
Sir, you can go ahead in that.
No, Jay, go ahead and explain that.
In terms of the clean energy, we normally maintain a 1 quarter inventory or maximum of 4 months inventory because of the supply chain disruption and long the imported material. We order in advance so that there won't be any disruption in the production. Our cost of funding as on today is around 5.2% per annum. So getting the raw material in time, on time is very important because a loss of production will impact very badly in the company. So the 4 months or 3 months inventory in the clean energy sector we maintain. In case of other areas where we already mentioned our WIP, it is meant for a future production. Almost 93 days of working capital is related to a WIP only. So other areas we have to get the material in order in case of the sheet metal enclosures and other areas. And some of the raw material we also get an advance. Almost 41 crores of money we received an advance from the customers for the raw material whatever we have in the company. So thereby we don't want to production disruptions. That's why we maintain enough inventory for the next 6 months, so there won't be any problem for a company to achieve its target.
So, sir, is this understanding correct? Typically, you keep 3 to 4 months of inventory. Right now, you are at 6 months of inventory for clean energy.
Normally, our target is we wanted to maintain 3 months, 1 quarter inventory for the next quarter deliverables in the case of clean energy. But due to long lead times in case of the supply chain issues, whatever we have, we are maintaining the inventory more than 3 months. But over a period of time, our objective is to keep the 3 months inventory in case of clean energy. In case of domestic projects, we will, because we get an advance from customer, as and when the project starts, once our design is complete, we will buy the raw material and get the advance from the customer. We don't have any problem as far as the material is concerned because we receive an advance also from the customer.
Understood. Sir, your entire clean energy order book, which is some 870 odd crores, is executable in next 1 year?
Yeah, it's basically what all orders we have received right now. Some of them are executed in the second half of this year and for the next calendar year. That's what it is. And we are also going to receive further orders to be executed in the next calendar year. So that's how it's going to be.
So which implies
the execution cycle time is very short for all these orders. So that's what it is.
Okay. So which implies your next 12 months clean energy revenue could itself be more than this order book number.
Yeah, that's right.
Okay. So the other question is on the commodity prices settling down. With this, do you think that we can actually go beyond this 30% band in terms of margins in FY24?
No, I don't think so, because whatever contracts we have signed for this year are already signed. And as I said earlier, it's a pass-through for us. Any increase in the raw material cost doesn't really bother the company. We are never affected by that till date. But we're saying the commodity prices settled down. They are not yet in terms of specialized sales. Inconel, 174pH, 440C, all the specialized materials are still on the higher side, but still it is a pass-through for us because the customers cover for us, so it's not an issue for us. But moving forward, probably we have to see, with if the stability comes into place, then it will be fine. But as I said, basically the second half is going to be much stronger than the first half. So whatever EBITDA levels we have given a forecast earlier, what that will be able to catch up upon and maintain that by the end of the year.
Okay. And sir, it's heartening to see some dispatches for sheet metal, some inflows for actuators. Can you help us explain what could be the timelines with respect to the larger order on sheet metals, actuators, or the screws?
See, we have received already the sheet metal plant is doing really well in terms of shipments happening between 12 crores and all, I guess, 11.7, 12 crores. We have orders for enclosures for about, I think, 700 sets we have to supply in this year, which we'll be doing that. That's about $3 million. Then we have another order which we have received for enclosures for 2,450 sets. So purely based on our qualification and quality, the customer has released order even for the next financial year, next calendar year, in fact. So all these things are adding up into moving MTAR into a more like a fully integrated system level. Since, as I mentioned earlier, the electronic side also we have started working on it. We have now completing the stage 1 of electronics in terms of cable harnesses. That's a stage 1. Which Bloom, we're going to get qualified for cable harnesses for Bloom and also for certain aerospace and defense projects as well moving forward. So all these things, we are moving in a direction where making MTAR a fully integrated company over the next 1-2 years. So a lot of wallet share is being added within the existing customer base and also with new customers. So that's where we are moving ahead.
Understood. Thank you, sir, and all the best.
Thank you. Ladies and gentlemen, in order to ensure that the management will be able to answer questions from all participants in the conference, please limit your questions to 2 per participant. Should you have a follow-up question, please rejoin the queue. Thank you. We have the next question from the line of Renu Baid from IIFL Securities. Please go ahead.
Yeah, hi, good morning, sir. I just have 2 questions. First, if you can help us give an update on how have been the new product developments proceeding, and by when do we see the commercialization of some of these new products in our order backlog in terms of firm orders? And second, with respect to new client additions on the clean energy, are we looking at other technology partners on PEM side? And if yes, if you can just share any updates, if any, that we have here. Thank you.
Good morning, Renu. So basically, the new product development, the first thing is the ASPs, the fueling systems in the clean energy segment. We have qualified for that. That's going to result for the next calendar year and partly for looking at next calendar year, basically. That's from January to December. We're looking at close to about 100 crores plus of revenues coming in from there. So this is purely based on the qualification that we have done. So this it's a great addition that we'll be doing in terms of revenue in the product portfolio. Roller screws, we have already submitted the first articles, and right now it's under clearance with the DRDO, hoping that they would give the clearance to us at the earliest, so they can put an import ban on that. Right now they're importing it from Norway, Sweden, both in space and defense and all these sectors. So that's a market which we're looking at. I'm not going to say that we're going to get 70 to 80 crores overnight, but over the next 2 years or so, we'll capture that kind of market in this area. Electromechanical actuators, we're executing the couple of 2 orders that they've given us. We should be able to complete it this year, where even the roller screws go into that, which we are going to use our own roller screws for that. So the EMAs are something which we are doing pretty well, so that would be another good addition to our product portfolio as well. And we are further working on other products as well, which will intimate the due time in terms of manifolds and other things which we're working on. So we're working on a lot of these products through our R&D department. As far as the new customers are concerned, I spoke about GE Renewable as our customer. We are being very selective. We are working with good customers where it can translate into reasonable and good volumes going forward. So GE Renewable is one such customer. We're also working with a customer called Fluence Energy from US for power storage systems, which is completely a very exciting project for us, which is going to be very innovative, which is going to give us volumes to the tune of at least about anywhere between 300 to 500 crores 1 year from now or 1.5 years from now. So we are looking at such good customers, working with them. And obviously in fuel cell segment, some of the companies are doing their prototypes. They're coming to a level where they'll start approaching us. Some discussions are happening. So that probably will take we are looking at another 3 to 6 months time where we can look at some of the customers coming in line with MTAR in terms of their requirements. So that's where we stand right now.
Sure. Thanks much and all the best, sir.
Thank you.
Mr. Cheda,
Yes.
I have unmuted your line. Kindly proceed with your question.
Yeah. Sir, our cash flow creation is very weak for the last 5-6 years that I'm seeing. And at the working capital cycle that we operate, every time that we grow 50%, we'll need external capital either in the form of debt or equity. So what are we doing to ensure that when we grow, the cash flow creation happens?
Yeah, this is so the major reason for the revenue growth, whatever we are witnessing, which requires a higher raw material and work in progress. As we explained earlier, our work in progress, because in the domestic sector, the projects are more than 1 year to 2 years. So I need to carry the inventory value addition till such time it's delivered. Conservatively, we are not recognizing revenue on the percentage completion basis. We go about the transfer basis. Conservatively, we don't want to book higher revenue and then reduce the work in progress. That is one of the reasons for higher working capital. Now, given the higher growth in the H2, then compared to H1, our target is a 200 days. The working capital days, we wanted to maintain 200 days by end of this financial year. So that is one reason. Second is our receivable. Out of the total receivables, 91% of the receivables are due, but not overdue. 9% are only overdue receivables are there. That is also because of the contract, whatever we have, some retention money has to be hold by the respective customer, which we will get it in this already. Out of the receivables, 20 crores we received in the month of October. So the working capital, the inherent nature of business requires a working capital. In case of the domestic customers, I need to carry inventory till such time it is delivered to the customer. And in case of export, the customers, credit period is 45 days after reaching USA. So all these things we have factored in the pricing. If you see the EBITDA margins are around 30% after the working capital, the cost working capital and funding. So this business requires higher working capital and have all the limits in place, and also the whatever you said, the capital.
I'm sorry to interrupt, sir. Kindly repeat your last line. We couldn't hear you.
Yeah, so the inherent nature, the nature of the business requires higher working capital, and also we are factoring the cost of working capital funding in the pricing of the product, whatever we sell. So that's why we are achieving the EBITDA margin of 30% and the PAT of around 19%. So this business requires a higher working capital because of the nature of the business, whatever we are operating. However, we wanted to maintain our working capital days to around 200 days by end of this financial year. We are already taking enough measures to improve the credit period of my and receiving advance from the customer wherever possible. So all those steps will give the fruitful results by end of the year. I think 200 days we will maintain by end of the financial year. And later on, we will take other stringent targets in the coming financial years also.
So what you mentioned on the revenue side, we tend to book our revenues when we deliver the product, is what you want to mention?
Yes, we are booking the revenue only whenever we deliver the products.
Sir, your line is not clear, sir. You are going.
Sir, your voice is breaking. I would request you to use your handset if possible.
Yeah, I'm using handset only. So, we are actually recognizing revenue as and when we deliver the product to customers, not recognizing revenue on percentage completion method, even though the accounting standards allow us to do, but we are not doing that. So the work in progress, we need to maintain work in progress till such time we deliver the product to the customer.
Sir, usually what is the execution cycle for your manufacturing?
So there is 12 months to 2 years.
12 months to 2 years.
Some of the projects, not all 100 projects. So maybe you can say 60%, 50% of the domestic customers projects, it requires 12 months to 2 years.
Okay. And the max working capital cycle, the lowest working capital cycle that you see is about 200 days as of now.
By end of the financial year, that is our internal target. We are taking enough steps to reduce the working capital by end of the year 200 days. We wanted to maintain. Accordingly, we are taking a lot of measures in terms of the improving the credit period of the suppliers and getting the advances from customer and reducing inventory levels. Following up the receivables more vigorously. So we wanted to achieve this by end of the financial year. And next year we will take further stringent targets in terms of the working capital reduction.
And so that execution cycle of 1 year which you mentioned, more than 1 year, that even in the clean energy business, that's the kind of execution cycle?
No, clean energy is not like that. It is, yearly, this year we are going to do more than 4,000 Huma hot boxes, and quarterly now more than 1,000 boxes we have delivered in the Q2 of this financial year. So clean energy is not like this.
And what is the execution cycle for clean energy?
It is like this. So presently, we are actually delivering more than 1,000, fuel cells in the quarter, in this one quarter.
Okay. Okay, sir. Thank you very much and all the best.
Thank you.
Thank you. We have the next question from the line of Dhananjay Bagrodia from ASK Investment Managers. Please go ahead. Mr. Bagrodia?
Hi, can you hear me?
Yes, please proceed.
So what are the margin differences between the segments?
We are getting, on an average, we are getting equal margins in all the segments, except in case of the fuel cells. There is 1 or 2 bips, 1 or 2 percentage of margin differences are there. That too we will mitigate with, given the higher revenues, whatever we foresee in the coming financial year and this H2 also. The margins are more or less same, except in case of a space, maybe 2% may be higher. Hello?
Mr. Bagrodia? Sir, I think the line has got disconnected for Mr. Bagrodia. We'll take the next participant, and the question is from the line of Kishan Amarchand Tosniwal from Polar Ventures LLP. Please go ahead.
Yeah, good morning. Congratulations, first of all, on good set of numbers. My first question is basically, did you participate in this Ahmedabad Defense Expo that happened just now? Hello?
No, we have not participated in this Defense Expo.
Any reasons? Was it not for our company was not having anything related to it, or just we are looking for something else?
So we have participated the earlier exhibition, but we are in touch with all the various customers, and we're also doing a lot of projects. But we didn't find it to be probably to participate this year. Probably moving forward, we might do that. But we already have enough on our plate at this point of time, and we are in touch with most of the customers in the defense sector as well.
Okay. And the second part is everybody has asked, just a repeat of it. The working capital cycle that you are saying that you'll be trying to get it to 200 days in this year by the end of the year. If I can ask you, what is our long-term target where we are satisfied that this working capital cycle, if we achieve, we are through? If I may ask, maybe 2 years, 3 years down the line.
See, the working capital number of days per se, we should not say. As long as we are actually keeping that cost of working capital in my pricing, we don't see any reason for the number it's per se. That is not the only parameter we see. Ultimately, today, with the various, government support and all, our interest cost is 5.4% per annum. By through interest equalization scheme we are opting. So the cost of funding per annum 5.4%. I am keeping this cost in my pricing, and thereby we are achieving the EBITDA margin of 30%. However, we wanted to reduce our working capital as much as possible. Some of the, in case of domestic projects, for example, we don't have any say on the, as far as the terms of the commercial terms of the contract into consideration, because it is all is dictated by the tender. So even one line or full stop, if I want to change, I cannot change. I will be out of the tender race. So domestic, we don't have any say. In case of exports, our credit terms is 45 days from the date it is reached to US location. So it is nowadays, because of the supply chain disruptions. Earlier it used to take 30 days or 25 days to reach USA. Now it is taking almost 60 days. There is almost 35 days of the higher, transit times. The working capitals are increasing, the days is increasing. I think we are hopeful that maybe next financial year, I think all the supply chain disruptions will settle, and it will normalcy will be there in the future. Then automatically the 35 days, whatever transit time is now we taking, it will not be there in future. So that will be one straight away reduction will come. In case of other things, like we are trying to improve, like 6 months back, we used to pay our suppliers, no credit period because of the COVID reasons. Lot of suppliers were asking for the upfront payment because of the cash flow crunches across all the sectors during the COVID period. Now again we bring it to 60 days now. Majority of some more suppliers we are working in this H2 also. Thereby enough steps we are taking to reduce to 200. Maybe next after that, I think we don't have a plan as such, because immediately we are attacking in this H2 of this financial year. Long run maybe 150, just because you have asked me. Now I will work for 150 days, then see how best we can do. But whatever it is said and done, we are actually keeping this cost into the pricing, achieving EBITDA of 30%, PAT of 18% above. That is the main objective of our company, is to achieve the profit numbers and revenue. Top line and bottom line is very important for us. And this is also important, but because of the nature of the business, I need to keep higher work in progress. And second is the domestic customers, the tender is dictating the terms. In case of US customers, the credit period is such that we need to have this working capital.
Got it. Thank you very much.
Thank you very much.
Thank you. We have connected the line of Mr. Dhananjay Bakrodia. He's online. Mr. Bakrodia, I will request you to kindly proceed with your question.
Hi. So I wanted to ask you, with now a lot of the larger players in India, conglomerates in India, have been speaking about how they've been focusing on hydrogen. What is something which, what would be our addressable market opportunity in such a big segment?
So the market space is very huge. We're not going to look at the market. The market is too big for us to even look at it. I mean, the market is not the issue. The issue is with the technology, right?
Okay.
So we are right up there in terms of technology, and this has to improve over the next 4-5 years. That's where we are. We have to start somewhere to end somewhere.
Okay.
So that's what is happening right now. So market is not the issue. Market is very huge for that right now, and we need to focus more on the technology to make it more viable for everyone. So that's what it is, and that's the kind of stage we are in today.
So just to break this down a little more, let's say, would it be like a large conglomerate would place one order and then only one person would get the whole value chain, or how would the value chain be broken up between companies like us and competitors? I'm just trying to understand where do we have enough opportunity, even if our technology does it have to correlate to someone else's technology also, or how does it work?
Oh, see, as I said, the way it works is if you look at different countries, every government has been subsidizing this whole green hydrogen projects in a big way, because that's where the whole world needs to be in. The way we are having the climate change is happening all over the place. So that's the priority. Now, that being the case, a lot of companies are focusing on how to build the technology and how to make it very viable over the next 5-6 years. That's what we're going to see. If you look at electric cars and all that, 10 years back, you won't even think about it. Right now, we're all talking about it. But moving forward, 7 years hence from now, you're looking at green hydrogen being the prime source for energy for everyone. So for that to be achieved, we are actually ahead of the game in terms of building with our customers in terms of this technology. And once that happens, then you can see, as I said, this particular vertical is going to be the biggest vertical moving forward, even in case of MTAR. So that's exactly where we're going to be moving forward as well.
Okay. So would it be fair to assume that there's enough opportunity for every player, and it won't just be one player's technology which gets picked by the conglomerates and then the other players lose out as such, right?
There's nothing like that. There's nothing like other players losing out. It all depends on what kind of technology they have. And as I said earlier also that the market is too big for us to really bother about it.
Okay, fine.
So there's enough to grab from the place. Whatever is a huge space which is available for us right now.
Okay, fine. Thank you. And so lastly, just one more question. Are most of our contracts fixed or variable because our gross margin movement?
What do you mean by fixed or variable? I mean, we have all the nuclear orders, we have a fixed kind of a pricing for that, but we have a price escalation clause for them, up to 20% to cover any variation. And other projects like space, the raw material is a free issue for us, so that's not an issue at all. Okay. And in the case of clean energy, it's a pass-through for any increase in raw material, the customer covers it for us. So that's how it works.
Okay, fine. Sure. Thank you.
Thank you. We have the next question from the line of Raja Mohan V, an individual investor. Please go ahead.
Yeah, thank you for the opportunity. Congratulations on the results and the phenomenal order bagging. Questions largely on clean energy. Broadly, Bloom is looking at a 30 to 35% growth over the next 10 years, aided by growth in SOFC as well as electrolyzers. Considering the various levers that MTAR has in terms of increased wallet share or increasing wallet share and constantly driving higher product efficiencies, doesn't it arithmetically translate to us growing higher than this 35% CAGR for Bloom? Does MTAR management have any internal assessments to share of the growth prospects of the Bloom business over the next 10 years? Whether it be 40, 45, 50%. Thanks.
No, it's we don't look at 10 years, but what's most important is two aspects here. How have we been doing in the last 1 year? How are we doing the next year or next 3 to 5 years from now? Yes, there has been a phenomenal growth in terms of what we have been doing for the customers. And secondly, also the various increase in wallet share through innovation for them. Some of the products what they're importing from Japan or from US, we are buying from US, we are able to get qualified for such products through our R&D to supply to them to increase their wallet share. So this also enables us to, that's what is happening right now. We have a great platform to address any other customer moving forward as well. It's very encouraging. That's what I said. You need to be at that kind of volumes for MTAR to really address their needs. So we're looking at customers to build their prototypes, and probably we might address their requirements as well moving forward. Yeah, the growth of Bloom has been very encouraging. We have a clear forecast even for the next 3-5 years the way things are going right now. And that's why we are proactively ensuring that we have enough capacities, enough developmental activities that we are doing to ensure that we are right up there in terms of deliverables for Bloom as year-on-year basis.
I understand, but Bloom generally is supposed to be, as you yourself have indicated, and Bloom themselves have, much more efficient in their products, 20-30% more efficiencies in their products than competitors. So when Bloom itself says it will grow at 35% per year, arithmetically I was looking at you growing faster with higher wallet share and this. Anyway, that is something which we should take in our estimates, kinds. As we finish half year this year, do we have visibility to guide on FY24 revenues, especially based on Bloom's budgets? Like we have orders worth 868 crores in clean energy, which we have indicated to executing 80% in calendar 23. And over that, we would get new orders also. And looking at number of hot boxes guidance, you have stated to it increasing from 4,000 to 7,000, which itself is a 75% growth. So I see us doing a lot better than the robust 55 to 60% growth you have indicated to this year. And I get a number of around 700 crores of revenues from clean energy easily possible next year. Is it a right guesstimate?
Yeah, see, you know how to do the calculations, right? So I don't want to say that. Obviously, the way things are going, how strong the order book is, the revenue growth is going to be very robust moving forward, second half as well as next financial year. So we don't want to give a guidance way ahead of time right now for FY24, but we are very excited the way we are growing right now and also innovating a lot of things in different segments. Yes, you're right, but we would like to stick to what we have said in the beginning of the year. And as I said, you under-promise and over-deliver. So, but you technically, if you calculate everything, you know what it is. So I leave that up to you, really.
And fine. One final question on margin improvement. With higher efficiency products, higher wallet share, economies of scale kicking in, would we see discernible improvement from, say, next year, resulting in structural yearly improvements in margins, even beyond the 30%? And we have indicated to, the CFO indicated to in the call, the clean energy segment also heading towards the company margins of 30%, though it is 100, 200 basis points below that. So when all that happens, from next year, do we see a structural possibility of improvement beyond the 30%?
See, first, the 30% EBITDA level itself, I hope it's a good margin level to begin with, right? So, as a company, we would always try to work hard towards improving our margins better and better. So, but that's something which we have to see. But yeah, you're right. Once the operating leverage is very good in the case of clean energy, it makes sense. But that's the endeavor from our side to try to improve margins as much as possible, wherever to reduce costs. So that's the constant endeavor from the company, and obviously things would improve moving forward, but let's see how it goes.
Thank you. One final question, if I can squeeze in, was effective tax rate.
Sorry to interrupt. I would request you to kindly rejoin the queue. There are many other participants who are waiting. Thank you. We have the next question from the line of Deepak Narnolia from Birla Sun Life Insurance. Please go ahead.
Hello. Am I audible?
Yes.
Yeah. Sir, the previous participant asked a similar question actually. I just wanted to, estimate your revenues. So, and the mix of the revenue. So basically what I see that this year, this particular quarter, your non-clean energy business has done really mute. It's very muted. It has done somewhere around only 24 crores of revenue. And you have outperformed in your clean energy business. So what the mix guidance you had given in the initial year, is it at risk like you had expected 40 to 45% growth in your non-clean energy business also? So as far as the revenue is concerned, so growth number you are maintaining it. Do you see that this job mix, will probably change and you will outperform on your clean energy business? Because this quarter you have done 100 crores of revenue in the second quarter, and that is a significant ramp up from 70 crores in the first quarter, and you have a very robust order book in the clean business also. So I wanted to understand that. And and sir, how many boxes you have delivered in this quarter, and how many boxes you would deliver in this year?
Okay, to answer your first question, I've said this earlier, the domestic revenues where we are working on some long cycle projects, whether it's nuclear or some space, where you remember we are looking at semi-cryo products that we're going to release by end of this year. All these projects are being executed by during the second half of the year. So whatever we have guided in terms of the domestic numbers, we would stick to that. It's not an issue. So that's on track. So normally in domestic projects, you have to look at not on quarter-to-quarter basis. You need to look at on an annual basis. So as you mentioned, on an annual basis, we will stick to those guidances with what we have given in terms of the domestic projects that we're working on in space, defense, and our nuclear projects, right? So that's not an issue at all. So that's why I said our second half is going to be more robust than the first half.
So what is the kind of revenue, sir, if you can guide something, what is the kind of revenue you do in non-clean business?
I can't give you the exact breakup, but whatever we have said earlier, the way we have the monitoring system, we are on track with that. Whatever numbers you have, whatever we have given, I don't have the exact figures right now, but we are on track with those projects being executed in the second half of the year for sure, right? So that's not an issue at all. Now, as far as clean energy is concerned, obviously, we have done more than 1,000 units of Yuma boxes this quarter itself. And the coming quarter, we are looking at about 1,600 plus. So we are right on track with the kind of numbers, the way it's growing. So clean energy is galloping, it's doing extremely well. So there's nothing wrong.
1,600 in one quarter?
Yeah, that's what we're aiming for this quarter. So
okay, for the third quarter?
Yes, that's what it is.
Okay.
So that's where we stand. So in fact, we're adding other products as well, which will come into play in Q4 in clean energy. As I said, the cooling system products which we're adding, which will add, that single product itself would add about 110 crores in the next calendar year. So we're adding a lot of new products. So what I'm trying to say is, clean energy is doing extremely well, but the absolute numbers of our domestic, which are in very niche area, which we are working on, those absolute numbers are also growing year-on-year basis. Don't look at percentage basis with respect to clean energy, right? If you look at the absolute numbers, it makes a lot of sense. So it's not that the other segments are definitely on track, and there's nothing to. We are really working towards building that more and more. The order book is also very robust for us in domestic business as well. So that will improve as absolute numbers keep growing higher and higher year-on-year basis.
And sir, as far as your working capital is concerned, I understand.
I would request you to please rejoin the queue. There are many other participants who are waiting for their turn.
Okay.
Thank you. A reminder to all the participants to limit their questions to 2 per participant. We have the next question from the line of Shirom Kapoor from Prabhudas Lilladher. Please go ahead.
Hi, thanks for the opportunity. I just wanted to get
the management's view on your defense segment and how you see this shaping up, going forward in the next couple of years. I know it currently contributes about 3% to the business, but do you see this number growing, or do you see, it's sort of staying at a similar level?
So as I said, even in the past, like I'm not looking at the percentage number in the domestic because our clean energy numbers are really growing very high. So we should talk more about the absolute numbers in terms of how we are growing year-on-year basis in terms of absolute numbers. So yes, moving forward as well, we are working on a number of projects right now, so it will definitely improve year-on-year basis. We have a lot of projects that we are looking at. We have the order book also for this particular segment. So, but we do mostly we work on a lot of R&D projects primarily for the DRDO in developing a lot of systems for them and products for them. So that's what we are doing. So obviously some of the products that we are working like roller screws and all of them will help. So moving forward, yes, you'll see improvement coming in this area as well.
Okay, and thanks for that. And just another question to understand your domestic versus export split. So is clean energy given, so just to understand, is most of the non-clean energy a domestic focused business, and clean energy is mainly export focused? Is that understanding correct?
Can you repeat that question?
Just to understand your domestic versus export revenues, is majority of the non-clean energy business primarily in your serving the domestic market, or is there a large export opportunity in that as well?
No, it's primarily the domestic market because in nuclear space, basically it's on the domestic market as well. But we are still exporting to companies like Rafael, LPTech companies like that, Bentel. So we have export customers as well in the aerospace division and defense sector. So we are doing that as well.
Okay, got it. Thanks.
Thank you. We have the next question from the line of Amish Kanani from JM Financial Services. Please go ahead.
Yeah. Hi, sir. I'm from PMS. Sir, you mentioned about establishing the EMS full-fledged facility. So if you can give us some sense of what is the plan, what are the investments, if possible. And second question, sir, is on the semi-cra engine side, space side. We have talked about delivering in Q4 one product. If you can give us some sense there of and you're talking about SSLV as a new product. I understand there will be a long lead time in terms of R&D, but if you can give us some sense of what should be the phase one of that, how long will be the timeline in terms of developing that product. Thanks.
So basically the EMS, as I said earlier, we are moving into the electronics division to make MTAR a fully integrated company. We are doing a lot of equipment where we are doing a fully integrated systems even today, but we would like to really ensure that we have this division within MTAR to make sure that we not only, a lot of our existing customers are asking for it and we can increase our wallet share with them. So we have already started the first stage of cable harness business that will get implemented by end of December. And then we do it in 3 different stages. So over the next 1.5 years, we would say that we would have implemented the entire capability of electronics into MTAR. That's what we are looking at right now. Mm-hmm. As far as semi-cryo is concerned, that's probably by end of Q4 we'll be able to launch the engine with ISRO. That's the target plan right now. It's a new engine. It's a developmental product which we are working on it with a much higher payload. Even ISRO is working with us to ensure that it's done by end of this year. So that's what we're planning to launch it by end of this year. SSLV is a project which it's very exciting for us. We started working on the designs of it. Also, the MOU from InSpace is expected to be signed sometime in the month of November. So that's a 3-year kind of a program in terms of design development for this project. Because as we are all aware, the government has given enough support, is going to give enough support in terms of developmental activity and also on the operational flights in terms of avionics and the launch pad at cost is what they're going to give it to us. So this is a project which will take MTAR to a completely different level in the space division. So our entire focus is on this. The best part is we have enough facilities to manufacture this within MTAR because we've already been working with the space division. So this is about a 3-year timeline is what we have right now. It might extend to about another 6 months is what we're looking at this point.
Is there any idea of the market opportunity, addressable market opportunity in engine versus SLVV? Some value. I know the numbers could be very initial and very
it's too premature, but it's going to be the numbers are going to be very large. But look, the 80% of the world market is on these small satellite launch vehicles. So that's what we're looking at. So that's the reason why we have taken up this project, and it will be it is something which our entire R&D and the entire team is working on this. So this will be something which will you're going to see the fruits of this in the 3.5 years from now. But a lot of work is going on this particular project at this point of time.
So this will be a JV or some consortium is what I think we are thinking about, right, sir? Or it will be independent?
No, it's not a JV. It's an independent of MTAR. It's got nothing to do with any JV. It's the only thing you will have the right support from ISRO in terms of avionics and the launch pad and things like that. So we're launching of the vehicle. So other than that, probably they'll support us with few testing facilities as well. We have to see that. But it's a completely independent product of MTAR.
Sure. That's exciting, and all the best, sir. Thank you.
Thank you. We have the next question from the line of Akshay Kothari from Envision Capital. Please go ahead. Mr. Kothari, I have unmuted your line. Kindly proceed with your question.
Yeah, am I audible?
Please proceed.
Yeah, you are, Akshay. Please go ahead.
Yeah, so, sir, my question is, do we undertake any development with DRDO, since you have mentioned DRDO is one of your customers?
Yeah, we have been doing that for the last, 40, 45, 50 years. We have undertaken a lot of R&D work with them, and we continue to do that.
So we do get revenues of R&D from them as well, because developmental revenues also we would be getting, right?
We will be getting the revenues. It's not done free of cost. It's developmental revenues we'll be getting from them.
Okay. And so, I think CFO sir mentioned about we do have an option as per accounting standards to go as per the percentage of completion method. So is there any specific reason why we are not opting for that method?
We have not opted for that method.
Go ahead.
Dinesh, you want to answer that?
Yeah, you go.
No, Jay, go ahead.
Yeah, see, because that some phone. So the reason for it, we wanted to conservatively, we wanted to work and we want to book the revenue as and when we want to deliver. But in case of new projects, which we will see in the future, because these are all the projects, I think last 1 year it is continuing in this practice. We wanted to continue the same till such time it delivered to customer. But in case any future orders which is having a overtime, the concept is there that we will see in the future. But without any taking any benefit out of it, we just want to go fairly and book the revenue. That is the main reason for us to opt earlier in this.
Okay. And sir, Elbit systems and Rafale opportunities are offset opportunity or other than offset?
It's a combination of both. Any MNCs that they're working on, maybe Rafale or whatever, it's a combination of what they require there and what offset clauses that they have here. But offset is technically out of the window more now right now because it's all about Make in India. So the government is pushing for all these companies to actually manufacture in India under joint venture. So that's the future in what we're looking at.
But they must have pending offset obligations which they need to fulfill in the next 5 to 7 years. So,
that will be done. That will be done for sure. But I'm saying moving forward, it's more of Make in India than offsets.
Yeah. Okay.
I'm talking about the new projects.
I'm just asking that do we foresee for next 5 years also any bigger offset opportunity from these customers as well, because they have a huge offset obligations currently?
Yeah, they have a lot of offset obligations. Yes, there will be residual offset obligations coming over the next 4-5 years as well. That will continue. Apart from that, for all the new projects is more of a Make in India kind of a concept, that they have to do a joint venture with any qualified Indian company to take their projects forward.
Okay. Thanks a lot.
Thank you. We have a follow-up question from the line of Deepak Krishnan from Macquarie Group. Please go ahead.
Hi, sir. Thank you for the follow-up opportunity. Just probably one question from my end. Wanted to understand how are we in terms of raw material procurement, especially from Europe. Is there any disruption that we kind of foresee that could impact us, or we think we're very well covered irrespective of what is current situation in the European geography?
We are totally covered, Deepak. That's why, we have been maintaining our inventory levels at a higher levels right now. Yes, there are some delays, but that's the reason why we have ensured that we maintain enough inventory levels so that we don't face a line down situation. The way I look at it, we are completely covered. So I don't see any issues with that.
Sure, sir. And any incremental capex that we would require from a clean energy perspective as we cross the 7,000, 8,000 box levels? So how are we kind of looking at it from, say, FY24, FY25 perspective?
Yeah, see, as of FY24, we have capacity for 9,000 units. So we are fine with that. But the way it is growing, probably for FY25, we need to proactively see how we can increase even beyond that. For how the electrolyzers vertical will perform, which is going to really ramp up much bigger, and all the new products that we are launching for next calendar year. So we have to evaluate all that, and that decision will be taken by end of this calendar year.
Sure, sir. Thanks for that. And just maybe one clarification. So largely the domestic projects where you're saying that you don't book revenue and a lot of it is stuck in inventory. Is it largely in the nuclear segment, or do we see similar impact in the space segment as well?
It's mostly in the nuclear and also for some projects like space, like semi-cryo, for example, right? They are in advanced stage of the engine, but primarily it's in the nuclear segment.
So, but once we deliver the product, there shouldn't be any problem on the receivables or anything because they're government backed essentially.
Yeah, absolutely. We never had any issues with receivables with any of these organizations till date. So there's never been that situation at all.
Sure, sir. Those are my questions. Thank you for the opportunity and best of luck.
Thank you, Deepak.
Thank you. We have the next question from the line of Vinayak Mota from Stallion Asset Management. Please go ahead.
Yeah, hi. My questions have been answered. Thank you.
Thank you. Ladies and gentlemen, due to time constraint, that was the last question that the management could answer. I would now like to hand the conference over to Mr. Srinivas Reddy for closing comments.
So I would like to thank everyone for joining us today. It's been a very good quarter for us, and even moving forward, as I mentioned, the second half is going to be very exciting for us, and even for the next year as well, and moving forward into the future years. We are doing a lot of work in terms of innovation, in terms of adding the various customers, increasing the wallet share within the customers, and adding new capabilities. We'll try to work more towards these areas. And obviously, people talk about the working capital number of days, but that's something which we are working on. But it's more on an external factor than an internal factor for the company. In terms of the delays in transit times to US, port conditions there, still the things are remaining the same. Hopefully by end of this year it will come down. And we will also bring down the inventory levels as much as possible till the supply chain settles down. And as the CFO said, we're targeting for 200 days. And probably moving forward for next year, we'll have even more aggressive targets. So we are on top of it. I want to tell this to all of you. And that should not be any issue for the company, even moving forward as well. Thank you so much for all your time. And hopefully we'll see you next time in the next earnings call end of the future. Thank you.
Thank you. In case of any further queries, please contact Orient Capital. On behalf of MTAR Technologies Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your